Hey guys, Credible Crypto here. This is a new video update that I'm making here. Very excited for this video. It answers a lot of questions that you guys have been asking me. I know it's been a while since I made my last video, and the primary reason is that everything that I said in my last major market update pretty much stands and is still valid. Nothing has really changed. We're still going through a major correction, and as I mentioned in my last update video, once this correction ends somewhere between, I would assume, $5,000 to $6,000, I do believe that the next move is going to be a major move back up above $14,000. So that has not changed. The correction has not yet ended. We haven't quite reached $5,000 to $6,000 yet. We did hit about 6,500. I'm expecting a little bit lower. Once that region is met, I do believe we'll start a move back above $14,000. I do not think that $3,000 or new lows will be met. I believe that was the bottom of our current bear market, and now it's just a matter of time before we break all-time highs. So that being said, guys, everything that I said in the last video still stands. If you want to see my analysis on that idea, please go ahead and check the video prior to this one, and you will get all the information that you need about the current market status. With that being said, guys, this particular video is going to be about a chart that I recently posted on Twitter. It is visible right here. You guys are looking at it right now. And I did have some questions about this chart. There's a couple of different ways to count this. Some people were asking why I counted it this specific way and why I didn't count it another way. And so I'm here to explain my thoughts, answer those questions. It seemed like a question that kept popping up again and again. So I'm going to go ahead and answer that question, and we'll talk about this chart a little bit as well, guys. So basically, guys, this chart is a chart of the price history of Bitcoin since inception here in 2010. As you guys know, I am a Elliott Wave practitioner. I follow the rules of Elliott Wave. I think that they give us a very clear insight into the macro picture of Bitcoin and various other assets. And so I utilize it a lot to frame my high time frame bias when I'm looking at these charts. So the basic premise of Elliott Wave, guys, and it's not, to make it very, very simple. Elliott Wave is a way of identifying trends, whether they be uptrends or downtrends. Elliott Wave is simply a way of identifying those trends, akin to market structure. Follows the same rules as traditional market structure concepts. A lot of people like to conflate it, and they don't quite understand what it means, and so they make it into this crazy thing that they think doesn't work, or that it's some sort of a magic analysis type of deal. I made a video on this as well about the misconceptions about Elliott Wave and what it really is. And quite frankly, guys, it's a way of measuring of viewing market structure, I should say, on various time frames. So the basic premise is that an uptrend is created by a series of higher highs and higher lows. As you can see here, we have uptrends, and we have uptrends within uptrends, right? So on this first leg that I have, within that leg we had a high, a low, a higher low, and then another higher high. So that is a series of higher highs and higher lows, which means that this was an uptrend, right? Then we got a larger correction, and then we continued up, and then we got another correction. I believe we'll continue up. Basically, we're making a series of higher highs and a series of higher lows, which tells us that we are in a macro uptrend, and we've been in this macro uptrend since inception, all right? That is the basic idea here. Now, at some point, guys, this macro uptrend will end. We'll get a larger correction, or what I call the real bear market, that'll essentially be correcting the entire movement of Bitcoin since inception here in 2010. And we'll see a much larger bear market, larger than anything we've ever seen yet. Not necessarily in percentage terms, because we have corrected in the past, 95%, 90%, 85%. So there's not really much room to go down in percentage terms. But as far as time goes, I expect this next bear market to last a significantly longer amount of time than prior bear markets. As you guys can see, prior bear markets have lasted anywhere between 1 to 2 years. I expect this next bear market, when it arrives, to last between 4 to 5 years, potentially longer than that as well. And it's during this bear market that I believe a majority of the altcoins that serve no use, that have no purpose, that are essentially get-rich-quick schemes by their founders, will be wiped out of the market. And from this culling of cryptocurrencies will rise the real cryptocurrencies that have real utility and that are actually going to be used in the future. All right. So I don't believe we're quite there yet. And I do believe we're on a major fourth wave correction here, which implies that we will see one more major wave or one more bull run to the upside before we enter that real bear market that's correcting the entire upwards trend of Bitcoin since inception. All right. Now I've talked about this chart before. You guys know how I use RSI to analyze this, but the idea here with RSI is that in macro bull trends on higher time frames, RSI tends to oscillate between 40 and 100, and in macro bear cycles, which we haven't yet seen, RSI will break below 40 and oscillate between 0 and 60. All right. As you guys can see on the higher time frames, we've maintained RSI above 40 for this entire uptrend, which is a very clear indication that we have not yet entered a secular bear market, and that is still yet to come. The first indication of that will be a break of this 40 level on the higher time frames, and that's when we can start, obviously. I mean, honestly, by that point, the correction will be well underway, and we'll probably already know we're in a secular bear market, but that'll be further confirmation of this secular bear market. So from here, guys, let's talk about the two potential counts on Bitcoin, what the alternate count is. Because some do believe that we are actually already in the secular bear market. They believe that we have completed 5 waves to the upside with our peak in 20K, and they believe that we are now in this longer term bear market that'll last for a number of years. And I'm going to talk about why I believe that is not the case from a technical perspective and from a fundamental perspective. We'll draw some comparisons to other bubbles that are, I believe, very similar to the current one that we're seeing, and we'll go from there. So we'll start with the technical aspect, guys, and then we'll move on to the fundamental aspect. All right, guys. So here we are on a clean chart of the Brave New Coin Index. Again, this is an index of price from Bitcoin's inception here in 2010 to current day here at 2019. And let's talk about the technical analysis of this chart and why I labeled the correction, or sorry, the impulse or the uptrend the way that I labeled it, right? So again, as a reminder, this is how I currently have it labeled. Currently working on this 4th wave, and then I believe we're going to get one more 5th wave to the upside. This is my understanding of how this count is. This is why I believe that the current market that we're experiencing has found its bottom here at $3,000, and after some more sideways movement will ultimately break all-time highs at 20K and go on another massive bull run, the final bull run in my opinion, before we see a massive .com like bubble crash. All right, so let's look at this. Keep this count in mind, guys, and I'm going to go ahead and hide this, and we're going to take a look at the alternate count that is being proposed. Actually, let me just go ahead and do this. Let me go ahead and hide the lines here. And my computer is a little bit laggy right now for whatever reason, so I apologize for the delays. But we'll go ahead and let's go ahead and make this. All right. So this is my primary count. All right. This is what I believe is the current count. Now the alternate count, guys. Let's go ahead and draw the alternate count out. This is the count that the other side is seeing. They believe that we have now completed our 5th wave, and we are now actually in a secular bear market. And many of these individuals do believe that we'll see sub $3,000 within the next couple of years, possibly going down to $1,000 to $2,000. Some are even claiming triple digits at this point in time. And this is the count that they are referring to. All right. And I'm going to go ahead and change the labeling on here so it's a little bit more clear. This is the count that they have, guys. 1, 2, 3, 4, 5. All right. Now, on a surface level, just by glancing at this chart, this is probably the count that I would come up with just from a very surface level look at this chart, because I can see a very clear move up here. I can see a wave 2 down. I can see another clear impulse up, another correction, and then another clear impulse up. And we know that in a 5-wave cycle, we have 1, 2, 3, 4, 5. We have 3 impulses and 2 major corrections to complete a 5-wave cycle. So from first glance, just by looking at this chart, this is the count that many would conclude is the correct count, because it looks very clean. I say it looks very clear, I would say, from a log perspective, and it looks like it makes sense, right? The run up to 20K was crazy. It was euphoria. It was everything you'd expect to see at the top of a major cycle. Now, guys, 2 things that I want you guys to keep in mind. First is that we are in log scale, all right? We are in log scale here. If we were to take log scale off, this chart would obviously look very different, and that's also going to be part of my analysis here. But this is what the chart looks like on log scale, right? Now, the second thing you guys need to know, for those that are unfamiliar with Elliott Wave, the general idea is that within a uptrend, within each impulse of an uptrend, we have 5 smaller subwaves. We have a smaller uptrend within each larger wave, right? So within this first wave, we have 5 waves. The third wave, we should have around 5 waves, and this final fourth wave, this final fifth wave up, we should have another 5 subwaves, right? So with that in mind, we're going to take a closer look at each of these individual moves and try and count the subwaves. That's going to give us a little bit more clarity as to what we're seeing here, and that's also one of the reasons why I don't have the count labeled this way, because from a subwave perspective, it doesn't quite look right to me, all right? So let's start off with the first wave, which is going up to $35 off of the lows from inception. We can see a fairly clear wave 1, 2, 3, 4, and 5. All right. Now, important thing, guys, we're on log scale. So another Elliott wave rule is that the third wave, all right, of any impulse cannot be the shortest wave in an impulse, all right? Which means that this third wave can't be shorter, can't be the shortest of the first, the third, and the fifth. And it means within each of these, the third waves can't be shortest of the first, the third, and the fifth. Now, although this third wave looks shorter than the first and the fifth, you have to keep in mind we're in log scale, right? So technically, this first wave went from $0, right, up to 48 cents. So it's a 48-cent move. And then we had a wave 2 correction. And then this third wave that looks smaller actually went from 17 cents up to $1.09. So this was actually a larger move, all right? It was actually a larger move than the prior first wave, right? This third wave, the smaller third wave, moved up close to $1, while the original first wave moved up about 50 cents. So although this looks smaller from a log perspective, in reality, this wave is actually longer in price terms and percentage, right? So this is still valid. So we have 1, 2, 3, 4, 5 waves to complete our first. That's all fine. Here we have our second wave. And this is where, guys, the discrepancy comes into play. This is where the major disagreement is between those that see this as the correct count and those that see the other version that I've posted as the correct count. So those that are seeing this as the third wave, all right, what I think that they're missing is a subwave count within this third wave, all right? What we can see here, guys, just very easily, is we have one wave up, we have a correction, we have another wave up, we have a correction, we have another wave up, and the computer is lagging again. All right, and we have a correction, and then we have another wave up, right? And what do we count here, guys? We have 1, 2, 3, 4, 5, 6, 7 waves, all right? We don't have a clear 5-wave move here. In fact, we have 7 waves, which doesn't quite add up. Now, in the way that I'm counting this, right, with the way that I'm counting this entire move, again, rather than us being a 1, 2, 3, I have this entire move as the first wave, as this equivalent to this first wave. I have this entire segment as the equivalent to this first major wave of 5, right? And the way that I count that, guys, is we have a 1, 2, 1, 2, 3, 4, 5, right? Which means our third wave actually ends here. This is the larger fourth wave, right? And then we have the fifth wave up to complete our first major wave to the upside, right? That would imply that this is our second wave, this major move is our third wave, and we're currently in the fourth wave before a final fifth wave to the upside, right? So keep in mind, guys, our Elliott wave rules tell us that, again, wave 3 cannot be the shortest, wave 4 should not enter wave 1 territory. These are some key distinctions and things that we can look for when we're counting our waves. And I want to take a look again at this third subwave section here, and let's see if it follows those rules, right? So our first wave goes from 175 to $7.21, about a $5 increase. All right, then we have our wave 2 correction, which bottoms out at $3.75. Our top of our third wave ends at $14.91. So that's about a $10 increase. So over here we had about a $5 increase. Our third wave was about a $10 increase, which means it's longer than the first wave. We have our fourth wave correction, and then we have our final fifth wave of this third. The fourth wave correction, does it enter wave 1 territory? It does not. If we take a look here, guys, and we check the bottom of the fourth wave and the top of the first wave, what do we see? We see that it ended right above wave 1 territory. It did not enter wave 1 territory, which means that this is a valid count. 1, 2, 3, 4, 5, all right? So that is my third subwave, and I was able to identify that because I counted the subwaves within this wave, and I can see a clear 5-wave move here, all right? So that means this was our third. This correction was our fourth. Again, the fourth wave, as I mentioned earlier, should not enter wave 1 territory. It does not enter wave 1 territory. And then we have our fifth and final wave alternate count. the one that I do not believe is the correct count, has us here with the first, here with the second, here with the third, fourth, and then fourth here, and then the fifth already being completed at 20K, and again, us being in a secular bear market, likely to see new lows sub $3,000. Now again, the key issues with this count that I see are as far as a subwave count goes. For this to be the third, it'd have to be a 5-legged segment. We see here 7 waves, not 5. In order for this to be a 5-legged segment, you'd have to count it as such: 1, 2, 3, 4, 5. And again, each of these impulses needs to have 5 subwaves itself, which means we should be able to count 5 subwaves within this third wave segment right here. And again, all I see here is 3 subwaves, not 5. And we see that 1, 2, 3 here, right? So the assumption now that would have to be made if you're counting this particular segment as a 5-wave move is that somewhere in this chop right here, in the sideways action, we actually have a much smaller subwave. Sorry, this computer is okay. So we have a much smaller subwave 1, 2, 3, 4, 5 to make this a valid third wave, then a fourth wave, then a fifth wave. I just don't see a 1, 2, a minuscule 1, 2 here before this 3, 4, 5. It doesn't look right to me. It'd have to be we'd have to force a 1, 2 here. Otherwise, I see a very clear 1, 2, 3, 4, 5. So that's why I don't see this particular count as viable, or I guess you could say it's viable, but I find it less likely than the alternate count, which is my main count. And again, that main count, with this being a very clear 1, 2, 3, 4, 5 for the third wave, and then the fourth wave and the fifth wave, and that completes our first major subwave, or first major wave 1 up here. All right. So 1, 2, 3, 4, and then 5. So that's pretty much the technical reason as to why I believe that we do still have one more larger fifth wave to the upside to go, guys. And now we'll dive right into the fundamental aspects of why I think that it's too soon for the $20,000 to have been the top. It's too soon for that to have been the .com era type of bubble crash. I don't think that the markets have gotten big enough yet. I don't think we've attracted enough speculators yet. I think we're still extremely early, too early to be calling this top right here the equivalent of a .com type of crash. We're just not there yet, in my opinion, guys. I'm going to talk to you guys about that now from a fundamental aspect about why I think we're still very early in the game and why I do still think we're going to see one more major move to the upside before we see that .com type of crash. All right. So we'll start off, guys. We also have this this adoption curve, right? And basically what this curve shows is that in any major technological advance, we see this type of an adoption curve, right? Which is a standard bell curve in which the innovators, or the early 2.5%, are the first individuals to get involved with the new technology. This is a time when not many people have heard about this technology, not many people are using the technology, and they have not adopted it yet. The innovators make up the first 2.5% of individuals that begin to adopt a new technology, right? So these are the early days, the initial Bitcoiners, the guys who got in 2010, they are the innovators, right? From there, we have another 13.5%, which are considered the early adopters. At this point in time, we've hit 15%, a 15% adoption rate of technology. 15% of individuals have now adopted this technology, and these 15% are now considered the early adopters, all right? This is where I think we're at. I think we're somewhere in this early adoption phase. After this early adoption phase, we hit the early majority phase, where another 30 to 35% of individuals begin to adopt this technology. At this point, again, it's called the early majority because we have now hit about 50%, right? We've hit a little bit over 50% of individuals who have now adopted this technology. It's mainstream, right? The early majority is mainstream, essentially, okay? And after the early majority comes a late majority. These guys are a little bit behind the curve. You can say that they are the older generations who are less savvy with technology. So when the internet came out, of course, the younger generations were the first to adopt it, and then it spread to the older generations. And the older that you got, the later that you generally adopted new technologies because you're not as familiar with the technology, right? So this would be the older generations, I would say, that were the late majority to adopting a technology. Let's take the internet in this case. And then finally, you have the laggards, which are the last 16% to adopt this technology. And you could say that, actually, I would really say that the late majority and the laggards are probably individuals in third world countries, countries that are usually behind the curve as far as technological adoption goes. They're the last to actually adopt a technology. In fact, I wouldn't even, I'm sure that the internet is still hasn't even reached the laggard phase yet. I don't know. I haven't looked into the data, but I would have to assume that 85% of the world is not currently using the internet. Um, I would assume that there are certain third world countries that don't yet have access to internet, right? So we can say that this laggard phase is the last segment in which the final market participants begin to adopt. All right, guys, so now that we have an idea of what this adoption curve looks like, let's look at it in relation to the internet and in relation to the dot-com boom and bust to get an idea of when it was during this adoption curve that we saw the major boom in the internet markets and when we saw the major bust, right? So the idea with any bubble, guys, is that initially it's all driven by speculation, right? When a new technology comes out, we're not sure of what it can do. We're not aware of its capabilities, so speculation runs wild. People have all these ideas of what this new technology will do, but we don't actually know it yet because it's so new, and that causes mass speculation um, and and periods of euphoria where the markets essentially get ahead of themselves, right? Before ultimately correcting back down when the realization of what these technologies will actually do surfaces, right? So once we realize that pets.com isn't going to, for example, the dot-com boom, pets.com isn't going to revolutionize the pet industry, whatever the case was, when that realization hit, obviously pets.com went from a massively overvalued stock to bankrupt and it vanished, right? So that's essentially how bubbles work. You have a period of when a new technology comes out, you have a period of speculation where speculation drives prices higher than they should be, and then ultimately the market and always ends up correcting back down once this speculation once speculation reaches a point where it's way ahead of the actual reality of the situation. So we go back, we revert to the mean, and then that cycle runs over again and again and again. So taking a look at this from the perspective of the dot-com boom and bust, we should know that the dot-com bubble, guys, as far as the timeline goes, guys, here's a very clean and clear chart that shows us the kind of the time frame of the dot-com boom and bust. Started in 1995. Where internet stocks started popping up. People started noticing the internet, realizing that it had some sort of a capability to revolutionize the world that we live in. And again, speculation began driving prices of internet stocks and the internet market up, up, up. This was in 1995. When the acceleration of this move officially started. The dot-com boom peaked in 2000, the year 2000, when NASDAQ hit its all-time closing high of $5,048. And at this point, we hit our peak, and then we saw the major correction that ultimately it took 15 years for us to get back to these highs after we crashed. So after 2000, we only hit the highs of 5,050 in the NASDAQ 15 years later in 2015. So essentially a massive bear market that lasted, again, the run-up took 5 years. The bear market lasted longer than that, and it took another 15 years for us to reach prior highs. And of course, now we're much higher than that. But this is essentially the timeline of the dot-com boom and bust, guys. So we may ask, what was the adoption curve? What did the adoption curve look like during this time period? From 1995 to the year of 2000, when speculation was running rampant, what was the adoption rate, guys? How many people were actually using the internet during this period of time? And what did that level peak at before we saw a massive correction of this speculation? So if we go to that other chart that I initially showed you guys right here, let's take a look. 1995. In 1995, we can see here that internet usage or internet adoption was at 13%, guys. 13% in 1995, and this is when the real bubble began building up, right? 1995, internet usage was at 13%, and then 1996, that jumped, or 1997 jumped to 19%. 1998, we had hit 25%, guys, and at the peak of the dot-com boom in the year 2000, we had hit 42% adoption of the internet. Again, this is U.S. households; it's not global, so keep that in mind. But 42% of U.S. households had adopted the internet in the year 2000. At the peak of the dot-com boom, 42%, guys. recall our adoption curve. 42% puts us in the early majority, I believe, in the early majority section of this adoption curve. When we had hit the early majority region of this adoption curve, that was after the early adopters got in, that was after the innovators got in. When the masses, guys, the masses, the majority, the early majority, when we had close to 50% of individuals who had adopted this technology, at that point, the speculation ended, the speculation collapsed, and we saw a dot-com bust, right? At that point, the speculation finally ended, and we saw a major correction that lasted 15 years. It took hitting the masses, it took hitting the early majority for the speculation to finally end. And that is when we saw a major correction. Up until that point, the markets were running rampant. They kept going up, 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 and up. And finally, when the masses were euphoric, when the majority was euphoric and tossing their money in, we saw a major correction, guys. And this is what I think is so important. Let's take a look at crypto adoption currently in the year 2019 and compare that to what we're seeing here with the internet. All right, so here's a chart. And again, there's lots of data out there, guys, and it's a little bit difficult to find. You can find various sources that'll have various percentages when it comes to crypto adoption, essentially. But generally, guys, they're all about ballpark about the same as this graph right here. This particular study was done to see how many individuals within these countries used or owned cryptocurrencies. This was done in 2019, so it's very recent, but keep in mind it's a sample size of about 1,000 respondents per country, which is quite small. I've checked some other data, some other studies that use up to 5,000 individuals in the United States, and the results did match the results that we're seeing here quite closely. So I'm going to use this, guys, but keep in mind that we're using a small sample data set. There really isn't that much data out there, but this will give us a general idea, guys. And what we can see from here is that cryptocurrencies being used or owned, essentially the adoption of cryptocurrencies, highest in countries like Turkey, Brazil, and Colombia. Notice that they're the highest in these I want to say like developing countries, poorer countries, I guess you could say, versus the U.S., U.K., Japan, Australia, the larger companies, the more developed countries. These countries have smaller rates of adoption. The U.S. is at 5% adoption, guys, in 2019. 5% adoption. 5% of U.S. individuals in the U.S. have owned or own cryptocurrencies. This is still so early, guys. This is insanely early. Recall that the internet boom sort of took off when we had 10% adoption within the US. And currently cryptos are at 5% adoption, similar in the UK, similar in France, Germany, Japan, Australia. Only in countries like Turkey, Brazil, and some of these countries up here is the adoption rate significantly higher because of geopolitical conditions or whatever is going on with these countries, which makes sense, guys. But the point that I'm trying to make is that we're only at 5% adoption in the United States of America and similar countries, guys. In fact, I would say the average for the world would probably be somewhere under 10%, I would think, right? So with this in mind, guys, if we go back to the adoption cycle, the adoption curve, sorry, we can see that we're still in the early adopters phase. We're not even at the early majority, right? We're at the early adopters phase, which in my mind tells me that it's too early for the $20,000 top to have been the massive top of this bubble. Way too early. We aren't there yet, guys. We need to rope in a lot more people, a lot more individuals. This thing's gonna get a lot bigger than any of us can imagine before we see a dot-com era boom, or sorry, bust. I don't think we're gonna sit at this level for 15 years. Adoption is just starting. We're still in the early adoption phase. It's growing at a very rapid rate, and it's going to continue to grow. I don't think we're gonna see a period of 10 years in a bear market at this stage, at the stage that we're in. We haven't seen the adoption to spur that type of speculation yet. That could lead to a major crash and a major bear market like the one that we're ultimately expecting to see. Now, guys, to further illustrate the size of the current cryptocurrency market in relation to something like the internet .com boom, let's take a look at the market cap of the internet stocks during the .com boom and the bust, right? All right, guys, so in 2000, on March 10th, the combined value of stocks on the NASDAQ was at $6.71 trillion, guys. $6.71 trillion. The crash began March 11th, but March 30th, the NASDAQ was valued at $6.0 trillion, and ultimately we dropped another $5 trillion, I believe, from the peak. So the Nasdaq actually hit, I think it's believed, between $1 to $2 trillion at the bottom of this crash. So it went from 6.71 trillion to 1 to 2 trillion, guys. Another thing to keep in mind: this was in the year 2000. If we adjust this number for inflation, what do we get in today's dollar value of when the dot-com bubble peaked? So I went ahead and used this calculator. 6.71 trillion, guys. In today's dollar terms, 6.71 trillion is equivalent to $9 trillion in 2019, guys. Essentially, the markets had gotten so big they hit $6 trillion in market cap. Current valuation in today's terms is $9 trillion before we saw a major crash. $9 trillion in market cap, over 40% adoption, again in the US, before we saw a major crash. The majority had entered the markets. The majority had driven price up through speculation. The majority had thrown in a lot of their money, and then we saw a major crash that wiped out the majority, right? As we know usually happens, the majority never wins. That wiped out the majority, took all their money, and collapsed the market, and we would be in that state, and we would never reach those highs for another 15 years, guys, after this event occurred, all right? Now compare that to today's crypto market, all right? A market cap of 1 trillion when we hit 20K in Bitcoin, adoption of less than 5% in the United States, and nowhere close to the size or the magnitude of the dot-com boom and the bust that followed. There's a few key distinctions, obviously, guys. I do think that the Bitcoin bubble is very similar to the dot-com bubble in that both the internet and cryptocurrencies, I believe, are major disruptive technologies. Both of them, I think, are on the same level of disruption, I would say. I think that the cryptocurrencies are going to be as disruptive as the internet was. I think the magnitude of these technologies is similar. But guys, another big difference is that today, with social media, with all of us having access to the internet, with it being so easy to invest in cryptocurrencies, this is nothing like it was in the year 2000, right? In the year 2000, you had to call your broker up on the phone to make a trade. You could not go on the internet and make a trade yourself. You had to call your broker up. Hey, I want to buy this. I want to sell this. Your broker would put the order in. That's how it worked. It was not as easy as it is today, where I can go online, like a 13-year-old can go online and go to Coinbase.com, create an account, and buy something, all right, if he has a credit card. But the point that I'm trying to make, guys, is it's insanely easy for individuals in today's day and age to invest in these types of markets. It was not nearly as easy for individuals in the year 2000 to invest in internet stocks, right? It was just a lot more difficult for the average person to invest in an internet stock in 2000 than it is for the average person to invest in cryptocurrencies or any stock for that matter in today's day and age. And furthermore, with the advent of social media, the volatility of these markets is magnified, right? It's amplified. Social media causes FOMO. Social media causes panic. If there's some big event that happens, the whole world knows about it at the same time. It causes fluctuations in the market, which means bigger bubbles, bigger crashes, in my opinion, right? In 2000, news was not spread this easily. We didn't have the internet was just growing, but we didn't have access to news as quick and as fast as we did today, which means that booms, that FOMO didn't occur as rapidly, and panic didn't occur as rapidly as well. It was a different market entirely. Yet that market in that day and age, being that difficult, hit $9 trillion again in today's terms, and hit 40% adoption before we saw this major correction and crash. So guys, even from a fundamental perspective, the point that I'm trying to make is that us hitting $20,000, less than 5% adoption, less than 1 trillion market cap, this is not, in my opinion, setting up for a 5 to 10 year bear market. We haven't hit that level of euphoria. We haven't hit that level of speculation yet. That level is still to come. That paired with the technical analysis that I showed you guys earlier in this video makes me very confident in the idea that 20,000 was not the top of the secular bull market, that we have another major wave to go, that we are going to see speculative levels hit highs that we haven't seen in years since the dot-com boom, before we see a major crash. Adoption will increase over the next few years, speculation will increase, market participants will increase, and investors will pile on and try to catch this next wave. And I think, and personally, just from my experience, guys, what I've seen regarding, I mean, I was here when Bitcoin was at a few $1,000s, and I watched it run up to 20K. And just from what I saw and my experience, the individuals that invested in 2017, a lot of my friends finally started paying attention when Bitcoin started going parabolic at 14 to 15,000, and some of them invested at those highs. Right, some of them pulled the trigger and threw some money in at those highs. Now they didn't throw in their life savings, they didn't throw in 20, 30% of their net worth, they didn't throw in 10% of their net worth. They threw in a few $1,000s, a small portion of their net worth to test the waters. All right. Most of the people that I know that invested at that time, again, my age, in their mid to young 20s, and they were testing the waters when Bitcoin was going parabolic because they couldn't hold out any longer and they felt tempted and they wanted to invest some money. They were not throwing in their life savings. They were not throwing in a big chunk of change. They were just testing the waters. And a lot of them lost whatever they threw in there. A lot of them lost a lot of money that they were testing with. But I think that the run to 20K guys finally got the attention of the masses. I don't think it hit the point where the masses, I wouldn't say masses, I finally got the attention of the younger generations, I would say. Most people my age, actually not even that, guys. The more I think about it, everyone that I talk to about Bitcoin that's not in the space or cryptos, or if I mention it, they're still clueless. They're clueless, guys. It's a select few, I would say. And it's interesting because I've been to big cities in California, the tech hub, the Bay Area, where technology, I mean, the internet companies are dominating essentially. And in those types of areas, yes, everyone that I talk to is familiar with crypto, at least at my age, and a lot of them have owned crypto, and it's pretty common knowledge out there. But if you go to other parts of California, it's not the same, guys. 9 out of 10 people that I talked about crypto, when I mention it, have no idea what I'm talking about. Some say they've heard of Bitcoin, but they don't know what it does. They don't know what it means. It's still very early. These are people my age, guys. These are people in their 20s. So imagine people in their 30s, 40s, 50s, and 60s that don't even know what Bitcoin is. Might not even have heard of Bitcoin at this point. We're not there. We're not at the point where the masses have thrown their money in yet. And to see a .com era bust in the cryptocurrency markets, we need to get to that point where the masses are throwing their money, where the masses are now familiar with this investment. They think that this is an investment that will never fail. They get ultra confident and they throw in a lot more than a couple $1,000s. And we're not there yet, guys. And I think that the run to 20K got the attention of many millennials or people my age, and some of them did dip their toes in. But I think once we break 20K, guys, everyone that was skeptical or that missed the last run up, the older generations that have now maybe caught their attention. I think once we break 20K, those are the guys that are finally going to step in. The millennials that put their toes in, they got their feet wet, but then saw this major crash. Once we break 20K again, maybe tempted to go in a little bit heavier this time now that we've broken the prior highs. So I think it's a matter of time before we hit those levels. I don't think we're there yet, and I am expecting again one more major wave up before we see a massive crash. So that's all I have for this update video, guys. I hope you guys enjoyed it. As always, if you guys have any questions, feel free to reach out. And stay tuned for the next market update. Will probably be released once this correction ends in the $5,000 to $6,000 region, and once we start making the move to the upside. Oh, one more thing, guys. One more thing. This is important. In case I am wrong about this being the correct count, and let's say even if these individuals are right about our fifth wave having completed here, we're now in a secular bear market. There's good news, guys. There's a light at the end of the tunnel. And that is that even in the case that my count is wrong and that we are in a secular bear market, I'm still expecting to clear 14K one more time, right? I'm still expecting something like this. Even if we're in a secular bear market, I still expect something like that before we come down and ultimately lose 3K, right? And in the worst case scenario, if we're in a secular bear market and I'm wrong about everything that I just told you guys about, the bright side is that I still expect a move above 14K before sub 3K is met. So in either scenario, whether I'm right or wrong about the macro count, the macro perspective, the macro picture, I'm still expecting a move above 14K before we hit sub 3K. So I'm still buying the crap out of these levels here, and I'm still expecting up before down, I should say, even in the worst of scenarios. So that's another reason I'm so confident I'm buying a lot at these levels and I'm not concerned. Because based on the lower time frame wave counts, which I've talked about in my prior videos, this is the next major move, whether we be in a secular bear market already or whether we are working on a larger wave 4. I do expect 14,000 to be cleared before we even have a chance of clearing 3,200, all right? And then once we clear this high, if I'm right about this being a wave 4, we'll see more sideways movement essentially before we break 20K. And if I'm wrong about that and we are in a secular bear market, then ultimately after breaking 14K and before breaking 20K, we'll likely come down and create new lows. Again, I find that very unlikely for all the reasons that I mentioned in this video, but that's the bright side to this scenario, even if I am wrong about the macro picture. So again, that's all I have for this update, guys. I hope you guys enjoyed it. If you enjoyed it, please like, subscribe, and share this video with your friends. I'll be very appreciative if you guys could do that for me. And yeah, feel free to reach out with any questions.